Hello, ladies and gentlemen, to this second day at MoneyConf. My name is Pablo Orbizo. I run Fintech and blockchain in KPMG in Spain, and I'm going to be presenting the various sessions throughout the morning in the Insights stage. I think we all know we live in times of rapid and deep transformation in all industries, and I think we are very, very privileged because we're seeing so many changes across the financial services industry, considering what has happened in the last 20 or so years, how it's affecting society. And if we think about the world not so many years ago, we have seen a lot of developments. Specifically in the financial services industry in KPMG, we believe Fintech is vital. It's transforming the whole sector. It's redefining the way in which entities, customers, and other participants interact between themselves and with others. If we think about payments, currencies, investments, and so many other areas, the depth of change is so significant that it's affecting the way in which organizations organize themselves, how they work together, their culture, and the way in which they service their customers. With all of this in mind, there's only one thing I have left to say, which is I think we have a lot of great sessions in store for today, and I hope you enjoy them. There's a lot of interventions with very, very knowledgeable people. So it's all going to be very, very exciting. And I hope, you're going to be able to participate and learn as much as I hope to do. We're going to be joined by a host of thought leaders, disruptors, innovators, and a lot more who will shine a light on emerging trends in fintech across a host of areas. There is one key element that I would like to emphasize, which is the insight stage needs to get the audience involved. For that purpose, we're going to have speaker Q&A sessions clearly marked on the schedule, allowing you to put questions to some of the most recognizable faces in financial services, such as the first chat that we're going to have right now in approximately 1 minute. The first session for this Insight Stage morning session is going to be the global state of play in fintech investment. In our first audience Q&A, we are going to be exploring what the future holds for the next generation of startup fintechs, many of whom are, as you would expect, attending MoneyConf these 2 days. To share their insights, please welcome to the stage Reshma Sohoni of Seedcamp, Nadeem Shaikh of Anthemis Group, and Moffat from Balderton Capital. The conversation will be led by Laurent Nizri. Welcome them all to stage, please.
Let's get more friendly. Good morning, everybody. So thank you for joining us this morning. I know the night was perhaps a bit hard, so we'll try to entertain a bit more you. Please remind, this is a Q&A session. So we don't have so much to discuss now. We are waiting for you. Is that working?
Can't hear us? Oh, you can't hear him. Okay.
I'm not the specialist.
Perfect.
Is it better? Yeah. So remind, it's not a panel really where we discuss for 40 minutes together. We discuss. I need you, my friend. We discuss with you. So please ask your question. It's a Q&A session, so think about it. And I will pick, randomly someone to come and ask questions. No, it's not true. But please think about the questions. So first, please present yourself, each of you 1 minute, for us to understand what is the difference between your different funds. Ladies first.
Sure. So we are a seed fund across Europe. Kind of started as Europe's first seed fund. We participate really only pre-Series A, so we want to be kind of a dominant brand across from Tel Aviv to, you know, Dublin, Nordics down to the Iberian Peninsula, and everything in between. Any rounds between 100K to 2 million. Our check sizes are 100K to 400K within those. And sector-wise, fintech is about 15% of our focus, and the rest is sort of health tech, prop tech, ed tech, you know, enterprise, SaaS, all of it. And just a few companies. Transfer-wise, we're in Revolut, Curve, Monese, within the fintech space.
Frogster, you mentioned.
Frogster, WeFox, yeah.
Quite good one.
Good.
Nadeem.
Hi, so we are Anthemis Group. We are an investment and advisory firm. We invest really from early stage to Series A, really globally, but most of the focus is US and Europe. We also work closely with financial institutions, really helping them understand how to take care of this innovation. We are exclusively focused on fintech. That's what we do across really fintech in the broader sense, anything from banking, insurance, wealth, payments. And proud to say we were one of the, and continue to be one of the investors in Seedcamp.
So I'm Rob. I'm a partner with Balderton Capital. Can you hear me or not? Yeah, okay. I'm a partner with Balderton. We are kind of a straightforward Series A venture capital firm. So early stage investing, check size 1 million to 15 million. We invest across Europe and we take businesses global. Fintech is probably 25% of what we do, and it's what I specialize in. So we're investors in Seedcamp in Revolut. We're investors in Nutmeg, Prodigy Finance, Go Cardless, Wonga, Zopa. So kind of a number of successful fintech businesses, and learned a lot through that. We've been going 16 years, portfolio of 60 companies, and a partnership. We have former head of capital markets at Goldman Sachs, 2 founders of billion-dollar software companies, so people with some real operational experience.
And by the way, I'm Laurent, the CEO and founder of Paris Fintech Forum. I don't invest money at all, so please go and see these guys for money. But we have the main event in Europe on fintech, so we see every year more than 600 of them coming and asking to be on stage and share. And we quite have a good view about the difficulties to raise money and so on. So my first question, the time you think about your question, would be, okay, we read a lot on whatever, you know, newspaper, Twitter, whatever social networks, that it's harder than perhaps the years before for fintech entrepreneurs to raise money in Europe, and globally, by the way. So first question would be for the three of you with your different kind of investment. What do you think about this assertion? Is it really harder in 2017 for a fintech entrepreneur to raise money at different stage, meaning the seed one, but also a bit later when you need to develop? So yeah, again, the same.
I mean, I'll talk about seed. You know, it's become harder for us to put money into seed stage companies. I would say it's probably differentiated between consumer and business. On the consumer side, I think, you know, we had so much activity in the last sort of 3 years or so, very early stage, you know, bleeding edge companies that we tend to back. So on the consumer side, we saw 90% of the activity from founders in that stage. And, you know, we made a lot of bets within that. So I think for us to do anything else in, you know, currency or necessarily challenger banks or some of the other kind of sectors, it's harder. We've made a few bets, and, you know, similar to us, other seed investors have made a bunch of bets in that stage. That said, the enterprise side is wide open. Sort of the SaaS enterprise side is wide open. Deeper into core banking is wide open. So I think if we saw, you know, as we see more in security, fraud prevention, identity, you know, within blockchain, et cetera, that's still very much open to very early investing. But I think if you're going for hardcore kind of consumer user experience, it's gotten harder at our stage. That said, our companies within consumer that are maturing in VC, it's amazing time to be raising right now. They're really getting a ton of interest, and yeah, it's a very good time.
Yeah, I think both statements are true, right? There's a lot of companies out there, a lot of crappy companies out there, right? So when people look at the aggregate saying, is it harder to raise capital? For them, yes. But then the companies that, as Reshma was saying, the companies that are really good and disruptive, it's the demand on the other side. They are the one in charge, and it's harder for us to invest because there's a lot of demand. They kind of decide who to take capital from. I think it's a
So it's more selective environment.
absolutely, but
Because you have much more people asking, so much more selective. The top one are really top, and the other one are really difficult.
yeah, like so easy to discount. So in the aggregate, you see a lot of people saying we're struggling for capital. They're struggling for capital because the business model is not good. Right? There's not really a business there.
Yeah, so I agree with both of those comments. The only thing I'd add, I think, is that in the US, the sentiment is overall negative towards fintech. Right? The average US VC is more negative about fintech now than they were 2 years ago. And we see from some of our portfolio companies raising Series B, Series C in the US, that there are a lot of firms who make a pretense of engaging and are not following through. I think that's much less so in Europe. I think most European VCs are long VC and still enthusiastic. So when we see it at Series A, Series B, there's a lot of appetite for businesses with good metrics. And then you have that sort of sector view. I think there's, as people say, currency exchange, lending, peer-to-peer are becoming pretty hard to differentiate now. And I'm personally more excited by insurance and by aspects of wealth management.
Yeah. Thank you. So perhaps let's take a first round of questions. Anyone? Yep. We need a microphone here.
Hi, panel. Hello?
Yeah.
Yeah.
Hello? Can you hear me?
Yeah.
I guess to the panel itself, what would be, in your opinion, what have more established players within the financial sector learned from the financial revolution, given the fact that so many upcoming companies have raised so much money and have grown so much from investors like yourself? So what has that been in terms of a teaching to established and more traditional financial establishments?
Yeah. I think it's changed a lot over the last couple of years. The financial institutions now are awake. They are really open to the conversation at the board room level. And almost every single financial institution at the board level now has a fintech agenda. Yeah? And they are actually trying to figure out how to engage in the space. Each one is trying to figure out different models. They are trying to figure out how to engage for the current business, but also think about the future options. It's becoming a space where they're starting to also understand that some of the stuff they were doing traditionally, just setting up fund and trying to invest on their own right, doesn't work. So a lot of them are coming with a much more diversified, innovation agenda that covers all the spectrums of innovation from today as well as the future. So a lot more activity. The insurance industry also now very much awake, and they were behind, but now I think they're caught up in the sense of engagement. What they're doing stuff is still there, not quite there yet, but it certainly is a informed conversation now.
I think, they're catching up. They are throwing resources at it. So you look at the sort of basic example, you look at the mobile apps of UK banks. Their mobile apps are now pretty good. In fact, some of them are very good. They've thrown a lot of resource at that because they've had to, but they have reacted. Some of it is built in layers on top of an old core banking system, and it's expensive to run, but they are making it work because they have to.
Another question, please. Still microphone.
Oh, what do you think about the concept of neobanks? Neobanks, and is there any trend of integration between different fintechs that are making different verticals? And can we start seeing, like, as I'm saying, fintechs from different areas integrating to have a more powerful offering to the market? That's more or less what the neobank concept is trying to get.
Yeah. I mean, a couple of things, bits to your question. I mean, on the neobanks, we took, in terms of our investment strategy, we took a very clear view that we would invest in light licensed fintech banks as such. So, for example, we're in Moniz, and it's a very kind of light licensed environment that they operate in, on top of a lot of banking infrastructure. A bunch of the other kind of challenger neobanks have gone very deep into licensing, and I guess our view on this is very clear. We might be wrong or very right in it, which is, if you look at the bank of the future, we think it's absolutely the wrong way to go. We think it's going to be light touch. It's going to be kind of things built on top of each other. And I heard a senior person at ING saying, if the biggest hotel in the world has no hotel assets, if the biggest transportation company in the world has no cars, the biggest banks in the world will have no balance sheets. And if you believe in that world, so we've gone the very light touch approach. That's one. In terms of sort of integration, I mean, I think that's the holy grail. I would say from all the user experiences of the different products, we alone have backed, I don't think we're there yet. Like, I think that the kind of integration that makes the end user happy and, wanting to work across different services, it's in theory right now, but the experiences are not strong enough across the board to really have an integrated play. So I think we're still a couple of years out.
You start to see the early signs of integration. So Revolut, who we're both invested in, they offer promotions for MoneyConf, for a wealth management service. They offer a loan product. You're seeing number 26 starting to build integrations with TransferWise and with other services. So we're seeing the early days of that integration, but it's still very much a lead gen approach. Yeah. And I think, what this will look like in 5-10 years is something much more smoothly integrated, and we're not there yet.
So, we invested in the space a while back, right? So Simple, Movin, Fedor. So we've gone through the spectrum of light touch, licensing to full red licensing, Monies, Adam Bank. So I think there's a complex space. A lot of these businesses have pivoted also from being a pure B2C player to be a B2B player as well. So they're kind of providing that layer on top of existing rails. And so the integration is starting to happen. People are thinking about this and stuff. And there's a lot of the API development and how to integrate all kinds of products into this platform. It's starting to happen. And there's a lot more focus on that, on the integration part, than just being a pure layer for the sake of that, right? And so people are starting in a space, in a use case, and saying we're going to solve for this, but slowly expanding their product set across the spectrum.
Any other question? Yeah, please.
Hi. You've spoken a lot about essentially B2C investments you've made, like the Revoluts, the Monies, the Nutmegs. What's your attitude towards B2B businesses, particularly where there's like large infrastructure plays being made? And I know you spoke about the SaaS and enterprise space a little bit, but the revenue models and the risk profile is very different from B2C versus B2B. And just what's sort of an investor's attitude to that?
Yeah. I guess what we're seeing, so we made a few investments in that area. Most recently, Comply Advantage, which is a KYC AML tool, sort of new approach to that using machine learning. We've also invested in a company called Credit Benchmark, who do crowdsourced credit ratings for entities. As far as we have a thesis, it's taking companies that do one thing extremely well. So taking one slice of the banking infrastructure and really focusing on that and delivering it. I think what scares us is a company that's building a monolithic core banking system that will take 25 million euros of development costs and then have a 3-year sales cycle. We want to have something that can get going faster, land and expand.
And, in the early stage, I think it's even harder because when you're putting in, $1 million or $2 million into a company, long sales cycles are killer in trying to prove points. One of the things we've done to get a little bit around that is we're partnering up with heads of sort of people who've been leaving Deutsche Bank and Credit Suisse and other places and UBS, et cetera, to say, let's do co-investing. Infrastructure, core banking. We know sort of business building in tech. Let's bring these forces together. And hopefully when they are selling into then Deutsche Bank and UBS and so forth, those sales cycles will be shorter. The trials will happen faster, so on and so forth. So that's kind of one of the things we've been doing in the very early stage to not just sort of say, well, that's an area we can't even invest in because it requires 5 million off the bat and 3 years to prove anything out.
Oh, you need a microphone, please. This one was high.
Yes, it's kind of an intriguing point. Why do you assume it costs 5 to 25 million to do something like that? Just like it's a random question.
It's a complex space, right? So we've been investing in B2B forever, right? Currency Cloud, Contemplate, and so on. So we have been in those businesses. Even Fedor is really a B2B business with a B2C angle to it. And so I think it's a complex business, right? You're in the heart of really, this is where I think Fintech is moving from too, right? So from the really consumer-facing businesses, and now we're in the heartland of financial services. So I think it's a really exciting space over the next 5, 10, 15 years. You're seeing, to Reshma's point, you're seeing a lot more mature folks coming in with a lot of experience, because in the space, you need to really know financial services. You cannot come in and say, I'm going to create an app and that's fine. You need to understand how it works to be able to reconfigure it. So that's where I think where it's going now.
And to your question, I think these banks are, to some extent, to a large extent, technology companies. So whereas some industries, you can come in with something that you've built with $1 million and it adds real value. You could do that in farming, for example. To do that in banking is not possible, or unless you've found something entirely new. So you have to deliver some real technology, and that takes time and money.
By the way, that's why I'm saying most of the big banks, when they buy out some, because they already bought, take over some of this B2B, and they say, yes, it was a great story, it was a great product, but not at all possible to integrate because it doesn't cope with our expectation when you manage 20, 30, 40 million customers. Often these solutions are built for really small use case. So idea is great, but after, what to do?
Another trend, I guess, is there's a number of enterprise blockchain companies who are raising nothing from VC or maybe quite small VC checks. And they're getting a lot of pre-funding from banks, and it's lots of paid POCs. And it'd be interesting to see how that develops. Right? You're Nearest, right? Yeah.
Monex.
Yeah.
Rebranded.
Okay. How's that going?
Really good.
Yeah.
Really good.
Yeah.
So absolutely, I think that's where the play is, right? So
Yeah,
really kind of bringing out the foundation blocks that's going into the B2 businesses.
Yeah.
Another question? Please?
Hi. I have an impression this is kind of UK based. I don't know if it's true wider in Europe, but with a lot of the platforms and the challenger banks, it seems that they've got lots and lots of capital coming in, but actually the challenge is deploying it. If you think that's right, how do you think that will play out?
For the challenger banks, you mean?
Challenger banks and platforms, so the peer-to-peer lenders, crowdfunding platforms.
As in deploying the cash and making loans, for example. Yeah.
So you've got Zopo isn't taking in any more money. Metro, I hear, has masses of deposits. It seems that finding capital actually is easy. Getting it out the door is more difficult.
I think that's why you're seeing Zopo going for a banking license. So they have much more flexibility in how they deploy capital, and they're not needing to match both sides of the marketplace. So I think that's the prime driver behind Zopo going for a banking license. And yeah, the temptation, I guess, is to go for lower quality loans if you're trying to keep growing. And there's a risk, I think, that one or two players in the market do end up going too far down the loan quality spectrum. Particularly given we've had a 7-year positive run on economic performance, it is worrying that, the temptation is there to sort of go down the path on loan quality.
I think it's such an interesting question, actually. And thinking about it from a kind of consumer business angle too. If you take kind of traditional tech, social networks, etc. You're seeing 100 million, billion, 2 billion user bases, and in fintech, that's unheard of. That's never happened, right? The biggest, outside of China, JP Morgan, others, the biggest banks have been capped under 100 million user base. And I think, in terms of capital is easy to find right now, deploying that is like, well, with such fragmentation in banks, in sort of financial services globally, it's all new territory. We think a lot about how TransferWise can get to 100 million, 500 million users, how Revolut can, get to that point, how you can be billion, 5 billion in revenue, but it's completely uncharted territory, especially on the user base side. So yeah, I think that's the challenge, is working through that, and whether that's, you get more licenses to have that flexibility, or you figure out how you're going to deploy that money beyond kind of cost of acquisition. I think it's a lot of the issues that are being talked about at the board level in these companies, who are breaking through and then saying, more and more sovereign wealth funds want to give us money, more and more money is coming behind us. All right, how do we break through? How do we deploy it? It's a great question.
Another question? I do have one. In the past years, we spoke a lot about neobanks, and again this morning, half of the questions are about neobanks. And we just saw the last 12 months, 2 big exits in Europe. Big for Europe market. So we had Fidor Bank, which was quite of the big one in many conferences and so on, and we just sold 1 year ago 100 million plus to BPC Group, a French group. And we had Compte Nickel, the French one, who just sold 200 million plus for a company with 500,000 active customers. So the question is, do you think the only way to develop and grow for a neobank, challenger bank, is to sell to a bank? Or do you think we could see like a real big one emerging in the coming months? Because we all know that's a lot of money needed to do B2C in that market. You need to inject a lot of money to buy a customer. It's not €1 a customer to acquisition. So what is your point of view on that?
So some good exits, right? So we wish they had taken longer to exit. We would like to hold them for longer. I think it's an interesting space, right? This is a life cycle. So if the bank you mentioned, 6-7 years in the making, right? And so it takes that time to mature. And I think the market is getting where there will be some regular activity, M&A activity, some consolidation happening over the next 5 to 10 years. You see a lot of that. I still think it's hard to do a B2C business and grow to the 100 million customer kind of levels. It takes a long time to do that. So a lot of these guys are going to pivot into being either niche players or being B2B players, right? And that's where I see the market going. Makes sense.
I mean, I think, yeah. So, from what I understand, selling to a bank is possible under 500 million. It gets very, very hard from what I understand, above sort of $500 million level in terms of banks really being acquirers. So I guess if you think of, again, some of our companies from across the portfolios here are well beyond that. And so I think, M&A is not the only option here, right? So I think we do start to think about IPOs or potentially outside of the banking world, who could potentially buy these companies at that billion, 5 billion, Stripe is valued at 9 billion, right? And so, you start to, they're far gone at this point beyond the sort of that ceiling that banks tend to have on a more easier acquisition. So I do think we'll see a plethora of acquisitions with, at that, under that 500 million level, but it starts to get, very interesting beyond that. And I think it'll be challenging for banks to acquire at revenue multiples, which they're not used to, right? So it's just not how they generally value businesses. So we're looking at the public markets much more, I think.
I think there is an incorrect assumption that people make is that the neobanks, and here I'm talking about the current account players, that they're spending a lot of money on marketing. That simply isn't true. None of them are spending that much on marketing. Number 26, Revolut, Monese, Monzo, they're all growing through word of mouth and through cheap app installs, and they're spending very little on marketing. They're not making any money on their customers either, or not making much money on their customers, but they're not spending on marketing. So these are not capital-intense models. I think the more capital-intense models are the lending players, the robo-advisors. Those do need to spend real money to acquire, but they're making a lot more money as well.
If I may, when a bank offers a credit card, they count that as a marketing cost, because they say, usually I sell it 100, so it's a cost because I don't sell it. When Monzo lost every single new customer £52 a year because they're free for everything, but they pay the service to the provider, you don't count that as an account, as a marketing cost. That's a bit tricky to compare the reality. So, of course, you can say they cost €1 for Facebook acquisition, but every service is free, and they pay the provider because they are not a bank. They pay everything to Wirecard and others guy. So Tom is saying everywhere he's losing £50 each new customer. £50 a year. So that's the cost of acquisition.
But I'm a First Direct customer, part of HSBC. They're also losing money on my current account.
Sure.
All current accounts lose money. They're also paying me £150, 150 bounty if I get them one customer.
I agree,
so
but they count that as an acquisition cost. That's what I'm saying. They count that as an acquisition cost. That's what I'm saying. It's not 200 against 0. It's 300 against 50.
Yeah,
it's not 0.
No, I agree.
No,
I agree. Yeah.
I think we're out of time, so thank you very much for everybody.
Thank you.
Yes, thank you very much. Fantastic timing. Yeah.